Good afternoon, everyone. This is George Sandman. I'm the founder of Growth Drive, and at my day job, I'm the CEO of CoreValue Advisor Software. Today, we're going to get an expert's perspective about the exit process from an M&A perspective, and we're joined by Michael Butler of Footprint Capital. Michael and I have known each other for years, and with that, Michael, I will turn it over. If you want to give an introduction, feel free.
Great.
And away we go. Thanks, Michael. I appreciate you being here.
Thanks, George. Thanks for having me, and good afternoon, everybody. Yeah, this is, we'll try to make this an interactive session, although I've got a lot of information to cover. And I believe a copy of this will be available to you as well afterwards, because there's several slides I won't spend a lot of time on. But in terms of an introduction, let's go ahead and dive into it here. As a credibility point, as George mentioned, I'm part of a M&A firm, investment banking firm out of Columbus, Ohio, called Footprint Capital. Here's just a little, this is a 2020 year in review. We're still working on we still have not pushed out our 2021 year in review yet, but just to let you know, this shows you a little bit about some of the tombstones on the deals we did both on the buy side and the sell side. We work on both sides, and our goal is to get people through the transaction process. A little bit about me. I won't spend too much time on this, except to say that I spent time as a CPA, both on audit and consulting. Moved on to a chief financial officer role, where I bought and sold several companies. We actually were the subject of an acquisition. I survived and worked for the acquirer for a period of time, and then worked in corporate America for a bit. And then most recently, I was a partner in a venture capital firm where we bought and sold our interest in new technology companies. So what we're going to cover today is the exit process. And just like any area that's new, there's always some unfamiliar territory, if you will, or language. And I kind of did this, a little bit tongue in cheek here with some of the buzzwords and acronyms that are used in the business quite a bit. There's, we talk about putting someone through a process, if you will, and that process is really helping to buy or sell the company. You enter into what we call an EL with an IB, and that means an engagement letter with an investment bank. We develop then a buyer pool, and we send out a teaser or an executive summary. And I'm going to cover all these. I'm just touching on one lightly here. We send out NDAs, non-disclosure agreements, which ultimately then, if they're signed, we send out a SIM, or confidential information memorandum, which hopefully will result in an IOI, or indication of interest, leading to an LOI, a letter of intent, then followed by DD, due diligence. Then a purchase agreement gets executed, and so on. And the reason I threw that all up there is just to show you that every business has their own set of acronyms, and I'm going to make you a little bit more comfortable with all of those acronyms. Today, here are the three things I'm going to cover for you. We're going to talk about exits in general, the types of exits out there, and a little bit about exit planning. We'll talk about the various advisors in the process. We're one of the advisors, being investment bankers, but there are many other advisors, such as attorneys, accountants, insurance professionals, family members. Everybody's an expert when it comes to an exit. Then lastly, and really the core of the presentation is walking you through what a sell side process looks like. What are the steps that we would undertake as an investment banker? And I'm really trying to do this illustratively, just for all investment bankers, not meant to be a commercial here for Footprint. But bottom line is, what can you expect? What does a sell side process feel like if you are the company that's being sold, or if in fact you are an advisor to the selling company? So we'll cover those. And as I said, there's a lot of meat in these slides, and some of these I'll cover them very quickly with the thoughts that if you need more detail, feel free to reach out to me, or feel free to refer to the PDF of the presentation. So first of all, let's dive into the first area. What is exit planning? And exit planning, as you might guess, entails a lot of things. There's personal, there's legal issues, financial, tax, value creation, and business issues. All those things incorporate, getting a business prepared and ready for an exit. A lot of times people will come to us when they're actually ready to do an exit. So we actually don't do much in the way of the planning side, if you will. We're actually generally involved with people that are ready to make that move and want us to take them to market. and take them to let's say, a list of various third parties is their most common type of transaction. But an exits, encompass quite a few, the bringing together of quite a few of these disciplines to make sure the business and the personnel, the owners are ready for that exit. Here's just a, illustrative result, kind of a graphic, if you will, of the various stages here: evaluating, preparing, deciding, and then ultimately executing. And these are things that kind of give you at the bottom, you'll see some of the, the several months that takes to even get to the point where you're ready to execute, is preparing the company. And hopefully companies, if they're doing this right, are preparing in some cases maybe years in advance, filling value gaps, filling holes in management teams, preparing for the exit of, let's say, an owner who might be a key participant in running the business day to day, and so on. So what I'm going to do is cover each one of these various types of exits. Okay, and we categorize these into two general categories. There are inside transactions, and there are outside transactions. The inside transactions, as you can see here, are family transfers, things that occur inside the company, as the name implies. And outside are the more typical ones that we get involved with, which are the strategic buyers, private equity buyers, and so on. I'm going to cover each of these and sort of the pro and cons involved with each one of these. So first of all, the family transfer. The pros and the cons. It's great for business to pass on to the next generation, but in some cases, the next generation, is not interested. It's the desires of, let's say, the children are not that of the parents to follow in the same course of action. We're finding that more and more with millennials these days. They've got their own ideas about what they want to do, and they don't necessarily want to be involved in the family business. So, even though this is great from a continuity point of view, you have to also make sure that the next generation is prepared for it. And the cons of this, as you might guess, are, there's family dynamics. There might be multiple children, and one child might have an interest in the business, and another not. And how is that fair to all parties involved? Paying the people in the business, but also, giving the fair share of the business to those siblings that are not necessarily involved. So with that, the good and the bad, and I won't cover these in great detail here, but let's move on to the next one here. A management buyout. Now, these are insiders to the company, people that know the business. These might be the management team that's running the business day to day for the owner, as an example. It's great because those people stick around through this process, and they become highly motivated buyers of the business, if you will, and they've been maybe waiting for their chance to take the business to the next level. The downside, of course, and this is the biggest one of the cons here, is really the fact that in many cases those management members, don't have the financial wherewithal to pull off a business transaction. They don't have the financial resources to buy it, and they also, in some cases, might lack the ability to loan money or gather the money to do it. So that's probably the biggest downside to selling the company to the management. And there might be an expectation that the owner would finance this, and that can be, that's got its good and bad features along with it. ESOPs, employee stock ownership plans. Many of you, I'm sure, are familiar with these. Some great things about this, that it certainly allows, a very altruistic, owner to really, allow the ownership to be shared with the company. The company stays in a great place. It can provide great motivation to the employees to continue to grow the company. But it is, a more complicated and expensive process to get through. And in many cases, the biggest thing that I've seen with an ESOP is that in many cases, the employees don't fully understand the benefit they've been given. And that's unfortunately kind of challenging. It's been a great thing that's done for them. And in many cases, they don't, feel that alignment or feel the wealth that's really, and the opportunity that's been given to them. But it can be appropriate for an owner who is prepared to take on certain amounts of risk and that sort of thing, and can be a great alternative. This is where you start to involve with people like myself, the outside buyers, strategic buyers. A strategic buyer, as I'm sure you are familiar with it, but I'll just say it to be clear, is someone who has, shares, let's say, maybe sells a similar product, maybe is a supplier, maybe as a vendor, all those sorts of things. It might be operating a business in another geographic area of the country, as an example. But in some way, shape, or form, there's a strategic connection between the buyer and the seller. It might share a customer base, as an example. And one thing about a strategic buyer is that they are in the best position to pay the highest price. And why is that? Because it's the old analogy or the old phrase that's been said of 1+1 = 3. Hopefully what they can do with the business is more than the normal buyer could do with it, or an unstrategic buyer could do with it. And so in many cases, there's cash up front. It can actually allow, in some cases, a business owner to walk away faster because the business is in, let's say, stable or experienced hands, and so on. So this is a really good, and really in some cases makes the best buyer for a business, certainly from a pricing point of view, and really an employee consistency and legacy point of view. Private equity or family offices, I put these two outside parties together because they, in many cases, are operating very similarly these days. Many of you know that a private equity is a fund, in most cases, and that fund is investors are putting money in that fund with expectation of value, of course. And private equity is, you may be aware, has quite a bit of money these days. In fact, many would say that it's actually has too much money in it. But what it allows it to do is go out there and chase companies. And frequently, if you are a business owner, you might be very familiar with the phone calls from private equity firms trying to entice someone into selling their company. More and more, the prices are higher here, or can be higher. It is financially driven. There are models being done behind the scenes, and rates of return for investors that must be met in order for deals to make sense. Taking this category plus the previous category together, the best buyer we tend to find these days is a private equity backed strategic, someone who is, let's say, already invested into an industry. And let me make that example a little more real. We recently sold a HVAC company. This is a consumer level HVAC company working on your heating or your air conditioning at home, let's say. And we actually sold that to a private equity backed strategic. And this was a private equity company that already owned several companies in the HVAC space and was looking to acquire our company, the company we represented, and add that to its stable. And by doing that, they knew quite a bit about the the buyer, the private equity firm, and the strategic company, knew quite a bit about HVAC. We're asking the right kinds of great, intelligent questions about the business, and are able to do quite a bit with it. They're able to share best practices. They might be able to reduce expenses, or they might be able to share marketing efforts and what's been successful in other areas. But that gives you an example of a private equity backed strategic, and in many cases, like I said, can be the best kind of buyer to find. So that's just a little bit about exits. Like I said, I skimmed the surface on that. I'm going to talk a little bit about the potential advisors involved in the process. Who are the folks? And many of you on the line are exit planners. You're involved in preparing companies for exit or growing the value of companies. And so, myself as an investment banker, I listed myself first, but we are, we call ourselves M&A advisors. There's also folks that are, business brokers that work at usually the smaller end of the field. Those are folks that are usually working on companies that are, let's say, below $1 million of earnings. We typically work on companies that are in the $2 to $5 million of earnings kind of category. That's our sweet spot. The other advisor, a very important member of the team, is the M&A attorney. And I emphasize not just attorney, but M&A attorney. Anybody you want to find someone who is a skilled deal person, as we call them, someone who's been around the block, who knows what market standards are in the industry. In many cases, an owner will bring their corporate attorney to the table in hopes that they can provide this service. And a lot of times will, I won't say frown upon that, but we'll suggest they make sure that they get an M&A expert from maybe the same firm or another firm to work with that attorney, if nothing else, or even lead the efforts, because that experience in the M&A field is crucial, and finding the right person is crucial. Your CPA, hopefully, most companies or businesses have some sort of external financial advisor, whether that's a CPA or just an outsourced CFO as an example. But that person is going to be instrumental in producing financial information, accurate and timely financial information to meet all the due diligence requests that will occur through this process. And a financial planner or wealth manager, we quite often, these are the people that get us introduced to companies, and what they're looking to do is take their customers that are involved, that are usually business owners, and have them take their largest asset, which is their own company, and turn that into liquid assets that they can help manage for that person's retirement. So those folks all become involved. Now, of course, there are other, I'll say, less, I won't say less important, but less vital other members in the group here. And those are spouses and family members, lenders, estate planners, personal friends with experiences related to exiting, and insurance professionals. There also are some insurance aspects related to buying or divesting a company. And all these folks together would make up the team, and getting a great team is super important. Let me talk just, since we're focusing on our role a little bit today, let me talk a little bit about what we do as an investment banking firm or an M&A advisor, and the value we offer here. So pardon the somewhat biased explanation of the role, but hopefully what we bring to the table is objectivity. We can help a business owner really determine the true market value of the company. And I say warts here. We certainly want to know all the warts of the company, all the things that aren't as attractive. There may be great earnings, but there could be lawsuits. There could be, supplier issues. There could be customer concentration, all those kinds of things. And our objectivity and our experience with these makes us, puts us in a good place in order to, help advise the owner what's the best thing to do to make the business as attractive as possible to potential buyers. Next, confidentiality. And why I mention this is the best example I can give you is if you're going to try to take, let's say you're a business owner, and you're going to try to take your company out to market on your own. Well, you'd have to do the reaching out to the potential buyers, and quite likely, people will start to get the idea of exactly who's for sale. We provide this level of confidentiality. We go out in a very confidential, no company identified kind of a sense out to potential buyers, and have them sign an agreement of confidentiality before we even let them know who's being sold. We do that through our outreach process. But it's important to make sure that customers, suppliers, employees, and competitors don't know about your sale until you're ready to tell them. And in many cases, that's when the agreement's already done, if you will. Obviously, employees is a good thing if they hear that a sale is in the works, and there can be some nervousness about their roles, and that could send them to, let's say, another competitor earlier than they should. And so with that, confidentiality is crucial here. Bad cop. Let me explain what I mean there. The old phrase, good cop, bad cop. We can play that bad cop role. We can help work with work for the acquirer and help them become the buffer between buyer and seller, that mediator in the process. And why that's very important, as I noted here after bad cop, is in many cases, immediately after the negotiations and the closing, you'll be going to work. As an owner, you may be going to work for a transition period for that acquirer for a period of time. And if you had a rough negotiation, it doesn't put you in a very good position to all of a sudden being on their side of the table the next day. And we can help buffer some of those emotions. Our level of experience, we're doing this day to day. We're saying, all we do for a living is sell companies. And so having that experience helps us best deal with very experienced buyers. And in many cases, we have a seller who's selling a company for the very first time in their lives. And certainly it needs to go and it has to go right. Market knowledge. We know what's a market term and what isn't a market term. Someone might ask for something in the legal agreement, and it's very often we can push back and say that's not what the market's doing these days. And as a result of that, is not an appropriate term to have in the agreement. Databases of potential relationships. We've got, in addition to our own relationships, we subscribe to some pretty expensive databases that allow us to identify strategic buyers, private equity buyers, family offices, and so on, or other just individuals involved in or interested in the types of business someone might be selling. And those databases, we spend well in excess of $100,000 a year on those databases, and would be difficult for someone to have access to those, or economically have access to those. That helps us to develop a buyer list. Focus. We allow the business owner to continue to focus on the business while we focus on the exit. Aligned interest. Our compensation is generally the majority of most investment banker or M&A advisors' compensation is mostly tied to success. We might get paid a small fee up front, but generally we get paid the vast majority of our fee upon success, and only if the deal succeeds. And a success in our mind is a closed transaction. Coordination with other advisors. There's a lot of parties, a lot of egos at the table here, and a lot of times we will help coordinate those advisors, those attorneys, those accountants, due diligence providers, whatever the case may be, and make sure that the transaction is moving towards a close. And lastly, and not to be understated, is emotional support. This is an emotional process. A business owner is selling their baby, if you will, and it doesn't go without some regret and maybe some frazzled nerves as it relates to getting through the process. And it's it can be quite challenging. In fact, recent story is we had someone who was on track for a great exit. In fact, it was double the amount he thought that he would get for his company. And towards the very end, he was getting questioned, I think, for a third time on a particular topic. And it finally was one of those as they say, the straw that broke the camel's back. He just kind of blew up and said, "Boy, don't you guys trust me?" We sort of had to get him refocused on the prize, eye on the prize, and the prize was obviously the great exit that was ahead of him. And he'd been asked for so many things and so many items along the way. His nerves were quite frazzled, and he just didn't need one more request. We were obviously able to meet that request, and with that, got him through the transaction. But it can be an emotional process, and up until the closing day, and even beyond the closing day. So that's the role, a little bit of the advisory team, or excuse me, the investment banker or M&A advisor. So our third topic was to talk through and walk you through the sales process here. So these are the various bullet points I'm going to take you through, kind of slide by slide. And in many cases, I'll show you examples of some live documents, if you will. And again, they'll be the print on these is rather fine, and it's not intended for you to read them necessarily. Although, like I said, if you get a copy of the PDF afterwards, you can certainly make use of that. And like I said, I'm always available for help. Glad to have anybody reach out to me for help and assistance to better understanding this. The first thing we do is getting to know the business. So, before I get to that, let me talk a little bit about how long does this typically take. That's one of the very first questions we get from a potential seller, and this is an illustrative chart of actually we took this from a recent example here of our goals at the outset of getting things going. We were getting this going on February 1st, and anticipating we would get this thing closed by 8:30. Now, I will say this. This example really illustrates if everything kind of falls into place. If you've got, if you have a very responsive buyer, and also you have all of your materials lined up very neatly, and that's sometimes not always the case. And the information requests are quite extensive. So you think you might have it all, and until you see an information request list that has some detail on there that you don't have at your fingertips. So with that, gives you an idea. This is it can be at best kind of a 6-month process. A lot of times he's run out to 9 months, and we've had ones that even during the COVID period here lasted as long as 12 months. Our certainly our goal is to get them closed as quickly and efficiently as possible, but sometimes the information transfer back and forth is a slowdown and so on. All right. Item one on the sales side process is getting to know the company. This is, there's a lot of words on this page, so I apologize, but this gives you an idea. This is our initial information request, even before we get signed on as an investment banker. These are the things we want to know as we start to get to know a company. A lot here. A lot of these things are at your fingertips. We would suggest the best thing for people to do is if they're starting to gather this information, put it in some sort of a virtual data room. Some sort of a Dropbox or type of a feature, because you'll be sharing it with other people. And so starting to build this out right from day one is a great suggestion. And you'll see here just information about the company, the details, the employees, organizational charts, financial information in all sorts of ways. And so with that, I want to give you an idea of how we get our ball rolling in terms of understanding what you're all about. The next thing we do is then we try to determine a business value. In many cases, a business owner has in their mind what they think the company's worth, and whether that's from friends that have sold similar companies in the industry or other industries. And what we try to do is we try to come up with a business value based upon what we see in the marketplace. But let's talk about business valuation in general. What makes a business attractive? And you can see here on the slide, market factors, business factors, forecasts, and so on. The other thing we always ask is the business owner ready to move on? Is their persona and their identity so closely tied to the business that it could be challenging for them to leave the business, if you will? And so it's important to know the business owner is running to something in terms of retirement or maybe enjoying life, as opposed to running from something, maybe the business. And they could just be burnt out. One of the biggest sources of reasons for leaving the business is just, I've been doing this so long, I'm burnt out. Or maybe there's a health concern that would not allow them to continue in their role. Here are the things that when you talk about traditional valuations that come into place, you have, there's something called the income approach, the market approach, and the asset approach. And again, a lot of great information around that. And what we also use, as you heard from George, we use core value as another component or another, information point here. We use a core value system to help our clients understand where they are in the process. And that becomes, part of what we consider, our valuation conclusion that we also, then we go back to the business owner with. Core value, if you're not familiar with it, and I think most of the people on this line are, is, it's a tool that we license, coming out of MIT, identifying value gaps. And it's a great, readiness for exit tool, but it's also a great health and wellness of the business tool. So even someone that's not even expecting to have an exit will get great bit of value out of this. 2 phases, discover and unlock, and I'm not going to cover too much on this. And it's centered around 18 value drivers. And these are 18 value drivers that business owners, that buyers deem important and business owners should be aware of and deem important as well. And just a little commercial for core value. This is the phase 1 output called Discover. Gives some great information on the potential business value and also the value gaps out there, things that if worked on and closed could result in higher value for the company. And the phase 2, this is a chart I show and sometimes spend a little bit of time on. I think most of the folks in the audience today are familiar with. This is the phase 2 of core value that talks a little bit about some of the things could be worked on. Those dynamite symbols indicate what's the biggest bang for the buck. And it's a great way to focus efforts if there's only so many things can be dealt with at a time. Now, while we use core value, we really don't you go through the process. We actually leave it to folks such as yourself, if you're an exit planner, to guide people through the process, spend that maybe year or so to fine tune the company for exit. A lot of times we'll refer companies needing this kind of effort to exit planners, and tell them when they feel like they're to the point where they want to take it to market, we're prepared to do that to help them. All right. So moving on from getting to know the company to the engagement letter. The engagement letter with an investment banker or M&A advisor or investment or a business broker, they can be kind of cumbersome, and generally they have exclusivity for a period of time, meaning that that person has the sole right to to sell the company. So you wouldn't necessarily hire, let's say, multiple investment bankers to take your company to market. The best analogy I can give you, if you're not familiar, this is a little bit like a real estate broker, if you will. If you sign with a real estate broker, generally you're signing on for exclusivity for some period of time. And there's also a commitment that if you end that arrangement with that investment banker, or let's say realtor, using that example again, there'd be a period of time that you couldn't just turn around and sell it to someone they introduced you to the month after and try to escape the commission, if you will. In the agreement, or a couple things here that I'll point out, is a little bit about fees. Typically there's a retainer or commitment fee that's generally charged. It's kind of the fee to get the ball rolling, if you will, and that can be as small as a couple $1,000 up to quite a few $1,000s. And what it does for us, at least, it gives us a sign that the owner is actually committed to the process. They put skin in the game in terms of a small commitment fee to get the ball rolling, and they are serious about selling the company. Then the biggest part of our fee, and most M&A advisors' fee, is the success fee. And that's a contingent fee paid at the time of closing, only upon success, as the name implies. And it's a percentage of the relationship, and it can be as high as 10% for small deals, or as low as 1%, or even below for large deals. In our market space of $2 to $5 million of EBITDA, and if you're not familiar with EBITDA, earnings before interest, taxes, depreciation, and amortization, our in the 2 to 5 range, typically our fee can be 3, 4, 5%, depending upon the complication of the transaction. And we don't have a standard fee off the shelf. We customize our fee based upon the transaction and what we're doing. So with that gives you just a bit about the engagement fee or engagement letter. From there, assuming we have a signed engagement in place, we'll move to identify potential buyers for the company. First thing we'll do, of course, is ask the owners who's been after you. Have there been people that have contacted you over the years? Are there people that are contacting you now? Feel free to send them our way. And even during the process, if they receive unsolicited requests, send them our way, and we'll certainly get them included in the process. But what we typically do, based upon what our understanding of the company and the potential strategic buyers, like we talked about earlier, we'll reach out to competitors, suppliers, distributors, products with similar customer bases, or other industry players, as I noted here. And those could be people that are operating the same business, let's say maybe in a different geographic space, if it's a business that doesn't have a national footprint. And we'll do this through our relationships. We'll do this through expensive databases, I mentioned, things like that. And we'll develop a really, a large, this kind of starts to take the story of a funnel. At the top of the funnel are all the potential buyers. And those also could include, as you see here, private equity firms that do both what are called platform investments or add-on investments. And let me explain that. Those are terms that are used in the private equity industry that not everybody may be familiar with. A platform investment for a private equity firm is a firm that's typically above $5 million of EBITDA, because they want something that's a little bit larger to get the ball rolling. And it would be, back on my HVAC example, if you recall a while back, the first investment into a given industry. So the first investment that private equity firm made into the HVAC space was probably a larger company that they call their platform company. It's kind of the core upon which they will build. And from there, once they've acquired that, they will do add-ons. Sometimes people call them tuck-ins, but an add-on is a similar business to the platform, as an example. It's like in our case, it would be our client was an add-on, and it could be someone who has EBITDA as low as 0, but typically they have at least $1 million or $2 million of some sort of EBITDA involved in the process, and so on. And also listed here, the potential buyers, independent sponsors is another group. These are folks that are looking to acquire a company and have, investors behind the scenes to buy those, and they might just be buying a single company. And ultimately then family offices. We didn't talk too much about family offices, even though it was on the previous slide. Family offices, these are folks that might have, let's say, maybe the money. These are wealthy individuals that have set up a family office to manage their money and their affairs. And typically you might find someone who has, back on my HVAC example, not to beat it to death, but let's say someone who's made their money in HVAC, who's now retired out of the business, but they know the industry and want to invest in it. And so they're not just satisfied having their money in public equities or invested in the stock markets, stocks and bonds, but they want something a bit more active they can wrap their hands around that has the potential for higher returns long term. So those are all the potential buyers. One thing we do with a buyer list is we put it in front of the seller, of course, and make sure there aren't people on that list that the seller would not be interested in selling to. In many cases, that list does get edited a good bit. In many cases, they'll say, "Here's a firm that I'm not comfortable with their reputation in the industry," or "Here's a firm that I don't want my employees working for in the future. I don't think it'd be a good future for them." So that list does get edited before we go to the next step. And that next step is reaching out to those potential buyers in a confidential way. We call it a confidential profile or teaser, if you will. And the teaser, and this is an example of an actual one on the right side of the page. A teaser is a one-page summary without identifying the company of really what the company's about. And we give some highlights, usually try to give an idea where the company's located, its historical returns, to give people an idea about how big the transaction is, and maybe just some bullet points. You can see it's a pretty limited number of bullet points on the firm. This is enough to tell a potential buyer if they would have an interest in this. And so on. But as I said, we also give these, a project name. This one was having to be called Project Power, if you will. And that's why we don't identify the company at this point. We don't want that information to get out in the marketplace, like I said, until we're ready. Accompanying the teaser is an NDA or non-disclosure agreement. And this is just the first page of the NDA that I've got off to the right here. But basically what it tells you is, it talks a little bit about the confidential information that will be shared and the fact that if some transaction does not occur, that information will be destroyed. It also protects the employees. There's what we call a non-solicitation phrase in there, meaning that let's say you are entertaining selling to a competitor and that competitor became uninterested in the company for whatever reason. Maybe the price was too high. They couldn't just go out the next day and start contacting your management team or any of your employees to solicit them to come over and join them. That would be forbidden via this non-disclosure agreement. Once that non-disclosure agreement is signed between the parties, the next thing we get into is what we call a CIM, or Confidential Information Memorandum. And this is just the lead page of one of them that we've done. And typically this is just a longer PowerPoint. It's usually 35, 40 pages long, and identifies, kind of as you can see off to the left-hand side, the company overview, strategic infrastructure, customer conversion, channel management, all these sorts of topics related to the company. It just gives great detail. And at this point, the identity of the company is then revealed. We then say, this is XYZ company located in Las Vegas, Nevada, and so on, and that because that signed NDA is in place. And this information, takes a while to consume, and so we send this over, and ultimately, then the next step is we ask for indications of interest or an IOI, and with that, this gives you an idea. This is a sample out of our typical IOI request. And what we ask for is, what are you willing to pay for the company? Give us either a multiple of earnings or a range of multiples of earnings, or give us a range of values. They may say, I'm willing to pay between 10 and $12 million for this company based upon what I see. And identify, what will be, what the plans are for the company. Identify the sources of those funds. We want to make sure at this stage that whoever is putting forth an indication of interest actually has the ability to fund it behind the scenes. So we'll in many cases receive, let me talk about the funnel for a minute. Let's say we have 100 buyers at the top of the funnel. Some of those might be edited out. So let's say we go by the seller. So let's say we're down to 95. From there, we'll send out to all 95 this NDA. And let's say we might have half of them sign it. Okay. Half of those groups then receive the SIM, the full complete information on the company. And then a subset of those 50, let's say, would then come back with an indication of interest. On a recent example, we had a company who generated 10 indications of interest. It was quite an attractive company in the trucking space. And from there, we then worked with the business seller to then shorten that list. 10 is a lot to look at. As you might guess, there are some in that group that didn't make sense, or their offer wasn't high enough, or had terms that we were uncomfortable with, whatever the case may be. And so you'd skinny that group down to, let's say, maybe 3, 4, or 5. And then the next phase would be bringing them in to meet with management and give them further information on the company, further access to the company, get a chance to actually see the facility if the company operates out of a facility, and go from there. And that's, I forgot I had a slide on it. It's called the management meetings. And again, we'd have, the owners would bring in certain members of key management to meet with the potential buyers. And the purpose is face-to-face meetings, seeing the physical location, meeting the employees that would be sticking around. And you can see here, we sort of have a laundry list of various things that would be on the agenda to cover. It goes another layer deeper than the SIM does, and allows that buyer to ask good questions. Once you get through that process, we then have a call for what we call letters of intent. This is where things start to get a little bit more serious. And even though a letter of intent is technically non-binding, it asks for someone to really define a price under which they'd buy the company. So you can see here, just a small excerpt from a recent letter of intent here, where they're offering $12 million to the company. And so with that, it talks a little bit about some of the commitments. There's information around net working capital, which is one of the customary adjustments in the process. But what it does is so let's say all the indication of interest people that came in for management meetings, that 4 to 5 group, they all may come forth with a letter of intent, but really only one letter of intent is ultimately chosen. And you go exclusive with somebody, meaning they're the only potential buyer you're then talking to for a period of time. And that could be let's say a 90-day period of time or longer. And that allows the companies to come together. This is where the buyer and the seller have sort of chosen one another, if you will, and the final details are worked out. And if it all goes according to plan, the next stage occurs. Well, due diligence occurs. This gives you an idea of this is a snapshot of the virtual data room related to one of our recent due diligence projects. And this gives you an idea of all the files and information that's maintained. But ultimately, getting through all of that, you come up and you would draft up, or attorneys would draft up, I should say, the definitive agreement, and you move towards a closing with that given company. And these definitive agreements, this is just the title page out of it. You have quite a few things in here in terms of representations and warranties, indemnifications, escrows and holdbacks, a lot of things that need to be dealt with. And this is where, like we said, a market savvy or an M&A savvy attorney is very helpful. We get involved in this process as well. We take a role in making sure we keep all sides talking and keep the process moving and make sure it doesn't get bogged down in legal, if you will. So those are the steps. And here's just a reiteration of the previous slide that I showed you with all the steps we've covered here. So thanks for your patience in getting through that. It's a lot of information. And I know we got some, looks like we got some Q&A and some chats here I'll get to in a moment here. But it gives you an idea of what is involved in a sell side process when you're talking to an outside buyer. And again, just a reiteration of the timeline involved. Kind of now that you've had an appreciation for what all the steps are, you can kind of see how all the steps fit into this 6-month time frame. And it does take every bit of that. Other items I thought were worthy we haven't covered yet. Preparation is super important. Getting your clients to prepare for this through good books and records. And this takes quite a bit of time. And our goal is to never distract the business owners from their core business, because the worst time to have a bad quarter or bad month is during that process. So that's really crucial. And one thing that is also is a consideration here is price is not the only concern. A lot of times when we talk to a new business owner who's looking to sell, they say, "Hey, Michael, we're looking to get the highest price we can get for our company." What they're not considering, though, is many of these other things. There are the timing of the payments, the terms associated with those, the legacy for them. Let's say the business bears their name. Is that name going to go away? What's going to happen with their employees? What's the transition period they're going to be asked to stick around for? Typically, you'll see someone ask for a year or maybe even 2 years as a transition, where they want the business owner who might have cashed out totally to stick around to make sure the business continues. There could be seller notes where they're asking the sellers to help lend money against it. And then there could be what we call equity roles, or really, saying, even though we want you to sell 80% of the company, not 100%, we want you to stick around with that other 20% ownership interest for a period of time. And lastly, I put it as a separate large bullet point, are earnouts. Earnouts are just a topic in and of themselves. This could be a separate hour to talk about the pros and cons of earnouts, but they are in many cases quite necessary and quite needed. And what an earnout simply is, it's not getting all the money up front. It's basing the payouts in the future based upon the positive results of the company. And sometimes those can be structured as a cliff amount. And by that, I mean, let's say you have to meet $2 million of earnings next year and you get an extra $500,000 gets paid, or they could be graduated. They could be some percentage of the future take, if you will. And this is just a very complicated and but necessary area. So let's do a quick review. I'm kind of heading towards home here. Then we'll try to take some of those questions. I've covered the types of exits here, and one thing we say to people is, all businesses will exit eventually, whether it's a liquidation or death of an owner, whatever the case may be. Businesses don't go on forever. They will transition to somebody. Planning is the key. Planning early, revising the plans, keeping track of plans, and so on. And they can benefit you immensely through the planning process. We talked a little bit about the role of the advisor here, and I think in my case, and my takeaway here is experience can make the difference. An experienced M&A advisor, an experienced attorney can all help make this process as smooth and as profitable and palatable as possible. And then lastly, we talked about the sell side process, and we hopefully demystified that a bit through walking through the steps and giving you an idea what it's all about. Conclusion, hopefully through this process, hopefully through the time we spent together here, you feel a little bit more confident in your knowledge of the exit process and comfortable with it, and have heard at least the acronyms and so on. So with that, let me pull up. At least I see one question here. How do you differentiate an investment banker from a private equity firm, from a broker, from Bill Size Sell? Okay, I think I understand the question. Yeah, so we all work at different parts of the industry, if you will. Let me take the easiest example. I'm an investment banker. We typically have a minimum of $1 to $2 million of earnings, and so on. A business broker are typically involved, and what you see on Biz Buy Sell as an example, if you're familiar with that website. Those are typically business brokers that are putting their listings out there. We don't use services like that. We run ours through what we call a private or closed auction, where we reach out to the buyers we're interested in. So we don't do that, and there's nothing wrong with that. But if you're trying to sell, let's say, a main street business, as we call it, let's say it's a restaurant or dry cleaner or whatever the case may be, or business of even not necessarily a main street business, but a business of a smaller size. Let's say it's a trucking company or something that's got a $500,000 of earnings, or a pet care facility or whatever the case may be. Those might be better situated for an individual owner that's looking for a business that they can run, and those are usually done through a business broker, if you will. I hope that helps. Let's see a couple of things in the chat here. I don't know, George, if you had a chance to take a look at these, and let's see.
I have.
Okay.
I have.
Any questions there, or are they just?
There were a lot of comments, but and I don't see. So Paul, thank you very much for your comments. And Paul made the point, I'm against lawyers leading, and I agree. I'm an attorney, and they probably do not belong driving the bus. So one of the things I'd like to open it up. We have a few more minutes here together, guys. If you want to, as a participant, just add in the chat or raise your hand. There's a raise hand thing. I would be happy to unmute your mic and add you to the conversation.
And as you're doing that, let me just cover this. I've always try to have some action steps, if you will. And the action steps I have here is, work with your business owners, help them prepare for this. Use a tool like CoreValue. We think it's a great way for people to really look at where they are today. The other thing I'd say is, have business owners. We want it's always I use this phrase quite a bit. We want the business owners running to something, not from something, if you will, and not running from their business because they're concerned about what's going to do next year, or if we just got through COVID, what's next? And now Russian invasion is next, I guess. We don't know what's after that one, but what does an owner want to do with the rest of their time, with the rest of their life, if you will? And it's a very positive story of a business owner says, "Hey, listen, I want to do this," and it's obviously when you have someone in their 60s, 70s, 80s, it's very apparent what they want to do is probably take a break and enjoy life a bit. But we've sold businesses for younger owners. I sold a business for a 45-year-old, and he had been at it since he was 18. So he had actually worked sort of a lifetime in the business already. He wanted to get into real estate. He just was, and that's not what his business was, but he was interested in just changing kind of modes, if you will. And then lastly, business owners need to start to assemble their team early. Their M&A attorney, their investment banker, that sort of thing. So I see a question here. Let's see what it is. Same question. Sorry.
Yep, no problem. Actually, I have a question for you. You mentioned so you're an active member of the community.
Yeah.
You are participating in the business advisor peer group. You have a ton of experience. This is a sort of a self-serving question, but I'm interested if you could elaborate a little bit on when and how do you use CoreValue, and maybe if there's a difference between how you use Discover versus the deep dive analysis.
Yeah,
would love your comments.
Glad to give them. Yeah, we use it in the earliest stages. It's almost a meeting one conversation we have. We said, hey, we've got a great tool. And if you mind taking the time, it shouldn't take you any more than 10, 15 minutes to complete. That's the Discover process, George. And what we have found though, and it really is true, I learned this from another CoreValue member, a lot of times people will be very excited about it. I'll send them the link and they won't fill it out. It becomes one of those last things, that at the end of the day, they don't get to. So it is helpful if you can to take the time to walk people through it, to actually take them through the questions. And I've heard other people say that I take them through the questions in a more informal way. I sort of, don't necessarily have it up on the screen, but I think taking people through that process, showing them what CoreValue comes back with as a value, but showing them in particular the gap, if you will. And George, I might have told you this story, so sorry to bore you, but I'll say this for the group. The very first person I took through this was a good friend of mine. And he was in the construction industry and he was thinking about exiting his company. He was 62 years old. He said, Michael, I want to kind of do this early because I know that sometimes I'll be asked to maybe stick around for a year or two, and I'm still able and willing to do that. And so I said, hey, listen, would you mind? We just licensed this new tool. Would you mind doing this for us? And he went through Discover and he said, wow, there's a pretty good sized gap there that I was unaware of. And then he went through phase 2 and he got more details on that gap, if you will. It kind of solidified. And what he said to me was this. He said, these are things that, there was no silver bullet there. There was no thing I didn't know about my business or didn't know there was no big gap that was uncovered. But what it did point out for me and it reminded me of is these are the things I used to do as a young man with my business. The documentation you talk about here and these kinds of things, and I've just, all this information is now in my head. And I have become kind of lazy. I've not prepared my business for a sale. I prepared it for my income. And so now what he did the rest of the story is he's prepared. He's actually still doing this now. He's been working on his business for the past couple of years. He's brought it in the next tier of management. He's replaced himself in the job. He's become less involved in the day to day. He's taken that sort of that owner dominance, we call it sometimes, out of the business. And he's preparing the company for for a buyer that would kind of de-risking the business, if you will. So I hope that helps, George, but that's how we use it.
That absolutely helps, Michael. Thank you very much. And we have some sort of supporting comments. One from Paul. We start and repeatedly use a statement of owner desires in the transition. Money is not the only factor, and this goes into your comment, Barry. It included saving some virgin trees on a property because the owners were environmentalists, et cetera. It gets to their, what is important to them that may not be part of the business. Barry chimes in right after that, concurring. We believe that if the life after business is crucial and to start early. And it's funny, that is something that I hit on in a video we recorded yesterday. Let's understand the big why. Why do they want to do this? What's their real goal? Because the business goal is easy to define, right? It's the ultimate goal that's much harder. We think it's about the money, but it's all about emotion. Barry, that's a great point. And then Barry follows up with CoreValue as an excellent tool to use for pre-due diligence. Many of the questions I've been asked through my career, and Barry is a veteran exit planner. When consulting on the sale of a business are in CoreValue. It's a handy, CoreValue is a tool and it's a very, very good tool. At the end of the day, it's a tool that is part of a bigger process that you've just described. So thank you.
Yeah.
And any comments you want to make in closing, Michael? This was a terrific overview. I have some great notes. And when we post the video, I'll make sure I bullet point those. You made some outstanding points. Thanks.
Yeah, no, I don't. Nothing else for me. That hopefully, thanks for your time, and we're glad to help if we can. We're very, I will say this, we're very low pressure, exit plan or advisors. And if people just want to have a conversation, we're glad to do that. That's how we meet the people, of course, and glad to help anybody that could use some help. And that's, I'm excited to be part of the CoreValue group because it's a lot of people that do what we don't do. We don't get involved in that year-long process of exit planning. We get involved in our own six to 9 months of getting them actually monetized, and then we pass it back to the wealth advisors that take it the rest of the way.
Yeah, fantastic. And those referrals, those introductions can be made inside the Growth Drive community. I'll make one comment on as we close out. We're having a conference in May in Charleston, South Carolina. That is the 3 days prior to an exit planning, the International Exit Planning Association's conference, which is just a half hour out at the beach. And getting specific training. So you're an investment banker who is obviously involved at the tail end of exit planning, and you work with exit planners. Exit planning itself is a fantastic discipline, a fantastic profession. And you're not an exit planner very long before you sort out that you need to get involved in growing the value. You may need to get involved in growing the value of a business. And that has a planning and an execution phase. And when you look at these together, you really bring a powerful story. I can get you from where you are today to the dawn of a transition and introduce you to and work with people I know and trust to get you onto the other side and do it the right way. Do it in a way that works for you as an individual. Does that make sense?
Mm-hmm.
Yeah, awesome. All right, guys, we are just past the top of the hour. This was fantastic, Michael. Thank you very much.
Glad to do it.
I will You guys, I will be loading this document, Michael's PDF, into the Growth Drive community. Go to growth-drive.com, click on community. It's free to join. That document will be in there, and as well as this video. So any questions? Michael had his contact information. This was great. Michael, thank you so much.
Thank
Everyone
you.
have a great day.
We'll see you.
Well. Bye.
Bye now.